For decades, the mechanics of corporate lending followed a strict path. When a business needed capital to grow, they walked into a bank and negotiated directly with the lender to secure their funding. Banks held a monopoly on this process because they possessed massive deposit bases, extensive credit departments, and deep existing relationships with the companies asking for cash. For generations, major business expansions relied on this centralized banking model to move money from savers to industry. Today, that direct line between banks and corporate borrowers is fracturing. Across the global economy, companies are bypassing traditional banks and securing their funding elsewhere. They are turning to private credit. Once a niche market for specialized financing, this parallel lending system has rapidly expanded into a mainstream asset class. What forces made borrowing outside of banks attractive enough to create an entirely parallel lending system? The answer reveals a radical, hidden mutation in the structural wiring of the global financial ecosystem. The catalyst for this shift traces back to the 2008 financial crisis, which forced government regulators to rewrite the rules of global finance. To stabilize the system, authorities legally required banks to hold significantly more capital in reserve and strictly limited their exposure to risk. These reforms changed the economics of lending. Customized, non-standard loans for mid-sized businesses became difficult for traditional banks to hold under the new capital requirements. As banks pulled back from this sector, they left behind a funding vacuum for companies that still required tailored financing to operate. The policy push designed to secure the traditional banking sector inadvertently laid the groundwork for a parallel market to emerge. Private credit funds stepped into this space. Unlike traditional banks, these institutions do not take public deposits. They raise capital directly from institutional investors. During a prolonged era of low government bond rates, pension funds and insurers searched for higher yields, finding them in the returns offered by private loans. Corporate borrowers found their own advantages. Companies undergoing complex restructurings prioritized speed of execution and flexible terms over securing the absolute lowest interest rate. To connect these groups, business development companies, or BDCs, became a primary conduit, channeling billions from institutions directly to borrowers. This alignment of self-interest created a reinforcing loop between yield-hungry savers and speed-hungry borrowers, accelerating the industry's growth. This shift transformed private credit from an emergency fallback into the primary engine for modern corporate growth. This ecosystem expanded from near zero to over $2 trillion today. But traditional banks aren't just being replaced. Federal Reserve data shows bank commitments to these funds jumped from $8 billion in 2013 to $95 billion by 2024. Traditional banks are now physically connected to the private credit funds through shared funding relationships and massive credit facilities. The financial system has transformed into an interconnected network where risks once held on bank balance sheets are distributed across asset managers and institutional investors. Specialized funds offer targeted expertise, and some argue that diversifying funding sources makes the broader economy less fragile than relying on a few megabanks. However, this parallel market operates with significantly less transparency than public bond markets or strictly regulated banks. The Bank for International Settlements has warned that heavy portfolio concentrations in hard-to-monitor sectors create risks that are difficult for regulators to see. While the system distributes risk widely, its lack of transparency makes it difficult to know where dangerous financial concentrations are silently accumulating. This new lending model has only existed during periods of economic expansion. It has never faced the pressure of a widespread, severe economic contraction. Some experts believe long-term funding structures offer inherent resilience, while others fear emerging problems will remain hidden in the shadows until it is too late. Companies borrow outside banks because the entire financial ecosystem reorganized itself around yield, speed, and regulatory avoidance. The path from saver to borrower is more complex and intertwined than ever, leaving the question of whether this evolution engineered a safer world or just shifted the danger out of sight.